So in today's video, we are going to cover what are drawdowns for beginner traders out there. Can they be avoided? And if not, and spoiler alert, they cannot be avoided. So what are some proven ways to reduce them? And we'll cover 8 different techniques that I've learned over the years from my trading mentors, who, as I mentioned earlier, have traded for decades, and books and podcasts and peer-reviewed white papers and professional traders out there who share these sorts of things. And then at the end of the video, we'll ask the question, how do I know if my strategy is broken? That's a topic for its own video, its own deep dive at some point. But we'll cover some basic things you can monitor to know whether or not your system might be broken. And now that's a dangerous word. Most traders stop trading their systems long before they are actually broken because they don't know when it's actually broken. And so we'll cover that later on in the video. But first of all, for the beginner traders out there who are new to trading, let's cover what drawdowns actually are by definition. Drawdowns are the amount of money you've lost since your last equity high. So equity high is just a fancy word for the most amount of money your system ever made. As soon as you start losing money, that is considered drawdown. It's usually calculated in percentage terms of your account balance, and it can also be time-based. So a drawdown doesn't have to be lost money. It can also be not making money over a long period of time. That counts as a negative drawdown experience. So here is a example image of one of the systems I trade that I developed. It's a daily mean reversion system that trades the Russell 1000. It trades up to 20 stocks, so 20 positions at a time. At maximum, it's not always trading that many positions. In fact, it rarely trades that many positions, but we have a pretty robust system here with thousands and thousands of trades over 20 plus years of data, including historical constituents. So survivorship bias is not included in this test. This is a system I've been trading for a couple of years now. And I'm going to use this equity curve example to highlight what drawdowns look like. So here are the majority of the major drawdowns highlighted on this chart. So the red boxes you see here are the worst drawdowns that my system has experienced since its inception. And we'll break down some of this information in a granular manner. So here we have a granular look at a drawdown during the drawdown. January of 2012, the system was still in drawdown. I wasn't trading it back then. In fact, I wasn't trading at all. I didn't start till 2017-ish. But this is my backtesting simulation. And at this point in time, we have no idea whether or not we are going to trade into new equity highs. Now, I've traded myself through several nasty drawdowns since I started trading, so I do know what this feels like in real life. Even though this is a simulated example, I've been through this in reality several times. It's not fun at all, but you can survive it, and that's what this video is about, giving you some techniques to apply or research. Not every technique will suit every person, but this is just some food for thought. So at this point in time, we don't know if the equity curve will continue lower, sideways, or onto new equity highs. And that is the challenging part of trading. That's what causes most traders to give up, is the uncertainty of trading. They get into these drawdowns and they don't know what is going to happen next because they haven't done the backtesting process properly, or they just don't have confidence in the system. And then that leads to system hopping, lack of discipline, inconsistency, breaking your rules, taking trades you shouldn't, exiting trades before you should, all that sort of terrible stuff that ruins most traders' careers. So in this case, this was a somewhat brief drawdown. Now I say somewhat brief. If we look down here, this is each vertical line represents 1 year of trading. So we were technically in drawdown here for about 6 months, which is not uncommon for an end of day trading system. As I mentioned earlier, this system trades the daily time frame. So it takes trades at the end of each day. Every morning, here in Australia, I get up and the US markets have closed. So I run my analysis, generate my orders, and place my trades for the next trading open. And sometimes I do that for 6 months straight and I don't make money on that particular system. Now I'll break down the techniques I use to overcome that issue in the first 3 tips that we'll get to in a moment for dealing with drawdowns. The next important thing to mention about time drawdowns is that obviously losing money is psychologically challenging. None of us like to lose money, especially as traders. But not making money for a long period of time is also psychologically challenging, and that's something we need to be prepared for when we're developing our systems and developing an understanding of our systems. Not making money for long periods of time tends to lead to boredom, first and foremost, which then leads to lapse of discipline, inconsistency, and worst of all, system hopping, which is the beginner cycle most traders get stuck in for eternity until they give up trading. They find a system, they start trading it, it goes in a drawdown, they think it's broken, they quit trading it, move on to another system, and that repeats until they get fed up with trading and give up. That's the reason most traders fail, in my opinion, is they never find a way to break out of that loop, and eventually they give up on trading. Hopefully today's video will help some of you with that issue if you're experiencing that. So this is what a time drawdown looks like. This is a drawdown that my system is currently going through. For about 1.5 years now, my system has not made a new equity high. Around here, the system did double top, pretty much, and then we went into drawdown. I made a new equity high here, and then we retested that new equity high, and I'm still down here a couple of years later on this particular system. Now, I trade several systems, not all of them are in drawdown like this, but this is the first system I've experienced that's had a really long drawdown. And mean reversion systems in general seem to have struggled over the past couple of years for whatever reason. Just the nature of the markets have changed to the point that they're not very conducive to mean reversion systems currently, at least not certain types of mean reversion systems like this one, which depends on volatility in a certain way to make money. We just haven't had that sort of volatility. So that's just some visualizations of how drawdowns look. Here's another chart. I didn't make this chart. The source for this is below in the at the bottom of the slide there. And this is showing a simulated trading system's equity curve. So the black line is the equity curve. The blue lines are new equity highs, and the red lines are the system in drawdown. And this big thick red line is the longest drawdown this system endured, which also happened to be its worst drawdown. It doesn't always have to be hand in hand. Sometimes you'll have a system go in a drawdown for a very long time, but it's a shallow drawdown, like in my case. My system is not that deep in a drawdown in terms of lost money, but in terms of time, it has lasted a long time. I've also had cases where a system's been in, hit its max drawdown, like 30% max drawdown in a matter of days or weeks, like in the COVID crash. But then it recovered the bulk of that money in a matter of weeks or months. So it rapidly recovered that drawdown. And so drawdowns come in all different shapes and sizes. So that's something that's important to be aware of and prepared for in your trading. Now, in my previous video, which I'll show a clip of here, did quite well. I think that's because I put my cat in the thumbnail. So you might have noticed I did that for this video as well to see if that helps boost the algorithm like a degenerate YouTuber. But we covered losing streaks and the math of winning in the previous video. So make sure to watch that if you haven't already. It covers some really important fundamental information about the mathematics of developing a profitable system. And in that video, we mentioned that losing streaks occur frequently, but they are not the main concern when it comes to drawdowns. Losing streaks do happen frequently, but that's not what typically leads to drawdowns. Drawdowns are usually prolonged and far more painful than a brief losing streak. As mentioned, they can last up to a year or more, depending on the system. If you're trading intraday, you're not going to experience year-long drawdowns. But if you're trading end-of-day, weekly systems, monthly systems, particularly in the stock market, then you need to expect to experience long drawdowns on some of your systems. Drawdowns are unavoidable. You cannot avoid them. There is no way to avoid them. Don't try to avoid them. Believe me, every single person on the planet has tried and failed to avoid drawdowns. The best traders in the world experience drawdowns. Even Warren Buffett experiences drawdowns. These things happen, and the way we deal with them isn't by avoiding them, it's by accepting them, managing them, and that's what this video is about. Managing your risk is the #1 key to surviving drawdowns. So if you take nothing away from this video except this one key fact, manage your risk, keep your risk small, and that will go a long way towards surviving drawdowns. But for the rest of the video, we will cover the 8 different techniques and tricks that I've discovered throughout my trading career that will help you guys. So let's cover tip #1. This is the king of drawdown mitigation techniques, and that is strategy diversification. So we've all heard of diversifying your stock holdings, holding different sectors, different markets, all that sort of thing. But what most traders fail to realize is that strategy diversification is probably the most powerful tool a trader has in their tool belt when it comes to managing drawdowns and reducing them. Combining multiple uncorrelated systems in a portfolio of trading systems is the best way to mitigate drawdown. It's the most robust method for reducing drawdowns because it reduces the issue of curve fitting. If you have 4 or 5 well-designed systems that are all robust in their own way and their own manner, and you combine them all and they're uncorrelated, then you are going to have a much smoother equity curve than you would if you're just trading one single system. So if you're a trend follower, for example, I consider myself a trend following trader. That comes most naturally to me. I like to ride winners. I like to let my winners run. But I also have mean reversion systems in my trading portfolio. I have relative momentum systems in my trading portfolio. Now you may wonder what's the difference between a trend following system and a relative momentum system. That's a subject for a different day. They're pretty similar, and you'd be forgiven for confusing them for the same thing, but they're not quite the same thing, and they do offer a degree of uncorrelated returns depending on how you've structured the system, especially when we get to the next tip, which we'll cover in a moment. There's also the option of counter trend or short trading systems. Personally, I don't have any short trading systems in the stock market. I do in the currency markets, in Forex, commodities, that sort of thing. But strategy diversification is the best method for reducing your drawdowns. So that's something I will prove to you in a moment. So here is an example of a strategy that I have been working on developing. Let's have a look at its metrics. So here we have the benchmark. So in this particular case, this is an Australian stock market relative momentum system. And so the benchmark is buying and holding an Aussie market ETF, basically, that tracks the underlying market. You can see here that the benchmark, if I were to just stick my money in an ETF and forget about it, I'd be looking at about an 8% annual rate of return, which is not bad. It certainly beats putting your money in a savings account, but we have a 50% max drawdown, which is intolerable for most traders, and it should be intolerable for most traders. Every trader should be aiming for a much better max drawdown than 50%. That's why we are traders and we actively manage our money, is to avoid situations like this. And so if we look at my system over here, the ASX momentum system that I've been working on has pretty mediocre stats, but it does beat the benchmark. So we have a 12% annual rate of return, beats the benchmark, and we've halved the drawdown, which is really nice. Some of the other metrics here, we have our MAR ratio. Ideally, you want this to be closer to 1 or more, but 0.5 is acceptable depending on the system metrics. Ignore the TMAR, that's a time MAR ratio that I haven't got the formula right for this particular test. That's something I'm working on in my own system analysis. We have about a 50% win rate, but we're still profitable. And if you've watched my previous video on the math of winning, you'll understand why that is the case. I don't have the risk reward metrics in this metrics example, but the momentum system has a much greater than 1-to-1 risk reward. So for every dollar I risk, I make much more than $1, and that's how I'm able to make money despite having a 50-50 win rate. So what we have here is a mediocre system. It's not great, but it does beat the benchmark. Let's have a look at a different system. This is my weekly mean reversion system. This system I do trade in the markets. That other system I'm working on developing. It's a work in progress. This system I do actively trade and have traded for quite some time. And it has a much better rate of return. We're looking at about 34% rate of return versus the benchmark. But our drawdown is much larger now. Now we have a 30% max drawdown, which is pretty up there for most traders. We have a 60% win rate here and a greater than 1-to-1 risk reward profile. That's how we are able to make a lot more money out of this system with only a 10% higher win rate or 11% higher win rate. So now what happens if we start combining our trading systems? Here I've combined 4 different systems. We have my weekly mean reversion system, my ASX momentum system. We also have my day trade system that I showed you at the start, the equity curve of that at the start, the one that trades the Russell 1000 every day. And we also have another system I'm working on here, a breakout system that trades the S&P 500. Here are my combined stats. So we're splitting our capital allocation 4 ways. We're putting 25% into this system, 25 into this, and into these other 2. And if we look at their returns individually, they're not fantastic because we're splitting our capital so thin, but the drawdowns are much lower. And the correlation matrix, which I don't have here, but if I did have it up, you would see that these systems are not very correlated in terms of their returns. If one's having a good year, typically the other one's having a bad year, and vice versa. And so they cover each other's weaknesses. And that's the point of having multiple systems in a portfolio, is they cover each other's weaknesses rather than trying to curve fit your system to market conditions or trying to guess what the markets will do next. I just trade a basket of systems that trade a basket of universes, a basket of time frames, and in doing so, I significantly smooth out my equity curve, and now we have about a 23% rate of return with just a 12% max drawdown, which gives us very, very nice risk-adjusted performance metrics. So our MAR ratio is a lot higher and our Sharpe ratio is a lot higher. Our win rate is healthy, our drawdown is healthy, our rate of return is healthy. But if we were to trade any one of these systems individually, they're either not very good, as in this system here, its rate of return was not great. This system here was much more aggressive, much better, but much higher drawdown. By combining all of these into a portfolio of systems, we smooth out our equity curve significantly. And you can see here our max drawdown bar count. This system was in drawdown for 317 days. That's how long its worst drawdown lasted. And its longest drawdown, not its worst, but its longest time in drawdown was 687 days, so over 2 years of drawdown. But when we combine all of these systems together, we end up with a much lower time of drawdown. So we only end up with a 72-day lasting max drawdown and only about half a year of our longest drawdown, historically speaking, over the past 20 years or so. So hopefully now you can see the power of combining systems, combining timeframes and markets. That is the best way to mitigate drawdowns. But there are other ways. We'll go over those for the rest of the video. But that's the best way to mitigate drawdowns: strategy diversification. If you are not trading multiple systems that are trading multiple styles, then you are missing out. As I said earlier, I consider myself a trend follower, but I trade several different strategies that are uncorrelated to each other so that I can smooth out that equity curve and manage my drawdowns better. Drawdown mitigation tip number 2 is market and currency diversification. So if I go back here, this is trading the entire broad Aussie market. This is trading the blue chip stocks, the top 100 Aussie markets by market cap. This is trading the Russell 1000, so smaller cap stocks than your average trading system would trade. This is trading the S&P 500, so the top 500 companies in America by market cap. And so this one trades the weekly time frame. This one is the monthly time frame. This is the daily time frame, and this is also the daily time frame. So we have 4 different universes that I'm trading, 4 different broad market indexes that I'm trading. We have 3 different time frames I'm trading, the weekly, monthly, daily, and 4 different trading styles, or technically 3 different trading styles. 2 mean reversion systems that trade different time frames, a monthly system that is a relative momentum rotational system, so it's constantly rotating into the strongest momentum stocks. And then we have an S&P 500 breakout system, which is kind of like a trend following system at its core. That is tip number 2, is not just diversifying your systems, but also diversifying the markets you trade and even the currencies you trade. I forgot to mention, 2 of these systems are trading in the Aussie market, so Aussie dollar systems, and 2 are trading US dollar systems. And if I split my capital across these systems equally, I'm diversifying my currency risk. If the Aussie dollar is doing poorly, usually that means the US dollar is doing well. And so I'm hedging my currency fluctuations, and all my uncorrelated systems are performing differently at different periods of time. So here are some examples. I also trade Forex and crypto. I trade the major currency pairs. So straight away I have a portfolio of about a dozen different currencies that are in my portfolio of systems. And so I'm diversified there. I also have a bunch of different crypto holdings, not as much as Forex, but I hold some Bitcoin, some Ethereum, some Cardano, and a couple of other crypto. So I'm diversified there. I personally don't trade futures, but if you did, there's all kinds of different markets you would want to trade in the futures markets. However, this comes with a caveat that mixing different markets, like trading stocks and Forex, is for advanced traders only. I would only suggest doing that if you are very experienced with trading. You're better off mastering one style of trading, one market, and focusing on that rather than spreading yourself too thin, especially in the beginning. For me personally, I started trading Forex in the beginning, and so I'm familiar with that universe. And then as I accumulated more money, more capital, I've moved over to more robust systems in the stock market. So I still have a fair chunk of money in the Forex markets, trading intraday systems, mostly automated, but I also have a sizable amount of money in the stock markets, trading the different universes. So tip number 1 is strategy diversification. Tip number 2 is market and currency diversification. Tip number 3 is time frame diversification, which I've already gone over. I trade the daily, weekly, and monthly charts on my systems. So that gives me another degree, another layer of diversification across my risk. All of these timeframes will tend to trend in the same direction over time, but they do get gyrations that are uncorrelated at times, especially when you're trading multiple system styles. I also trade intraday on Forex, like I said, but that is for advanced traders only as well. Because of the many hidden risks, typically you need to employ high degrees of margin to trade intraday and to do day trading. So that is highly risky for beginner traders. So I wouldn't recommend starting there, but for traders who are experienced with the other time frames, adding in an intraday system is a great way to diversify your risk across time frames. So here is an example of time frame diversification. Here we have my daily Russell 1000 mean reversion system. It has a 26% return with a 24% drawdown. If I combine this system with my weekly mean reversion system, which has a 34% return and a 30% max drawdown, have a guess at how my metrics would look. Would they be better or worse, do you think, in terms of drawdown and risk-adjusted returns? They are much better. So I actually get a slightly increased rate of return with a significantly decreased max drawdown across both systems by simply combining two different time frames and two different stock market universes. The systems are both mean reversion. They both are very similar, in fact, in how they enter trades. But one trades the weekly time frame, one trades the daily, one trades the broad Aussie market, one trades the Russell 1000. And that's how you get a much lower drawdown without having to do anything crazy. I mean, I just trade two different systems and I've already halved my drawdown nearly and increased my rate of return to a very healthy 36%. Now, theoretically, I've backtested them rigorously. I know they're very robust. And so healthy returns there. So the best way to mitigate drawdowns is to combine tips 1 through 3. And that's how I do things. These are the different systems I trade. It's a bit overwhelming, but I trade a monthly relative momentum system on the Aussie markets, a trend following system on the Aussie markets, mean reversion on the Aussie markets, relative momentum on the US markets, mean reversion on you get the idea. And we have different time frames, different currencies, and this significantly smooths out my equity curve. Yes, it's a complex operation, but it honestly doesn't take me very long each day. Because I'm trading end of day, end of week, end of month for a lot of these systems, and my Forex intraday system is automated, I probably spend 10-15 minutes on my trading per day on average. Most of my time is spent researching and backtesting and developing systems and putting videos like this together in my spare time. I also have a little bit of real estate holdings and some physical gold and silver, discretionary long-term investments. I'm diversified all over the place, and that helps mitigate my risk significantly. If you take nothing else away from this video, it should be to manage your risk properly and consider diversifying across time frames and markets, and primarily systems. Let's run through a few other tips. Let's go through the next 4. The next one is volatility adjusted risk. So this is modifying your position size based on the underlying market risk, or volatility, it should say. So a good way to do that is employing the ATR into your position sizing algorithms. So you want to have a smaller position if the asset you're trading is highly volatile, and you want to have a larger position if it's not highly volatile. If you're trading a system that trades a volatile market and it has fixed position sizing and it's not adjusting for market volatility, your drawdown is probably going to be quite high. One way to reduce that drawdown, and it will dilute your return slightly as well, is adapting your position size based on market volatility. There's a bunch of algorithms out there for doing so. Andreas Klenau has a great book on volatility adjusted position sizing. I'll link that below somewhere in the video description. Stocks on the Move is the book. He has some somewhat advanced position sizing algorithms in that book. That's worth checking out if you are interested in this sort of thing. The next thing is modifying your position size based on your tolerable risk. So let's say Trader Joe has $100,000 to invest into a trading system. The system he wants to invest in has a expected max drawdown of 28%. This is too much for Trader Joe. He can only psychologically handle losing about $15,000, which in this case would be a 15% drawdown on his 100 grand. So what are his options? He either needs to find a different system that has a much lower drawdown, or he can simply allocate less money to this system than his full 100K. So let's say this system has a really healthy rate of return, but he doesn't like the drawdown. So he can divide his wanted drawdown, which is about 15%, by the expected drawdown of the system, and that gives you about 0.54. So he simply needs to multiply his initial capital by this number in order to get a allocation that he'd be comfortable risking. In this case, that would be only 54% of his capital being allocated to this system with a max drawdown of 28%. If that system hits its max drawdown of 28% and he only has $54,000 allocated, now he only loses $15,000 of his initial capital. Now he can follow the system as designed comfortably. I've highlighted as designed because that is the key here. We want to trade the system as designed. We don't want to be breaking our rules, being inconsistent, introducing unnecessary levels of discretion into the system in terms of what trades you're taking and not taking and skipping trades and all that sort of thing. You want to avoid that. If you want to trade a system with a high drawdown, this is one way to go about it. Not financial advice, just theoretically. This is something to consider. I've learned this from Nick Raj, one of my trading mentors that I've learned a lot from over the years. The issue with this is that you need to rebalance periodically, so it's a bit more high maintenance. You'll need to take money out, in other words, if the system starts making a lot of money and your max drawdown capital exceeds your comfortable tolerance. You also need to be aware of commission drag. If you're trading $100,000 and you're paying a specific commission amount, let's say it's $20 per trade, $10 to buy, $10 to sell, that's going to eat into a $54,000 account a lot more than a $100,000 account. It's probably not going to be an issue, but it depends on trade frequency. If the system's taking a ton of trades, $20 per trade adds up quickly, especially on a smaller account size. So that's something to be aware of with a system like, or an approach like this to trading a system and adjusting your risk capital based on your tolerance for risk. Let's look at tip number 5. This is stepped position sizing based on drawdown. So this is similar to tip number 4, but I'll break down an example. Let's say Trader Joe can only stomach a 30% drawdown at worst. So his risk tolerance has increased slightly. He's more experienced at trading now. He has more confidence. He can handle 30%. He has a great system. It has a 30+% rate of return per year, and he's looking to get rich off this system over time. But its max drawdown is 33%, which is beyond what he can tolerate. One option is to step down your position sizing as you approach that max drawdown. So for example, if the system hits a 20% max drawdown, Trader Joe halves his position size, which means he's halving his risk, which means he is slowing down his drawdown accumulation significantly. And then if the system hits a 25% drawdown, he halves it again. And then by the time he hits 30%, he has slowed down the drawdown significantly. And he's much less likely to blow through that 30% max drawdown. And if he thinks the system is broken, he can catch it in time by slowing down that drawdown significantly. The catch is this also slows down drawdown recovery and it reduces the rate of return on average. And what that means is if you halve your position size, that means it's going to take twice as long to recover the drawdown. If you encounter a winning streak and you start making that money back, you're going to be making less money. And by definition, that means a slower recovery of drawdown. But when it comes to risk management, there's no such thing as a free lunch. We pay for it either way in some form or another. If we're reducing our risk, we are typically reducing our rate of return or the time to recover our money, which goes hand in hand. So that's something to consider if you're using that method. Tip number 6 is a slight variation on tip number 5. So I'm cheating here, kind of. I'm splitting up the two different versions of this approach. So we have this approach, initial approach. One other option is the way that Jerry Parker, one method that Jerry Parker, famous turtle trader, if you don't know about the turtles, go and research them. That's a fascinating story and lots of valuable information came out of their experiment. Jerry Parker suggests that for every 10% your portfolio declines, you decrease your position size by 20%. So this is a similar example to the one I suggested, where each time you hit a benchmark of drawdown, you halve your position size. This is a more slower paced version of that's drawn out a bit more. So if you hit a 10% drawdown, you reduce your position size by 20%. And then if you hit a 20% drawdown, you reduce it by 40%. If you hit a 30%, 60%, and so on. And that, again, slows down your drawdown accumulation significantly. But again, also slows down your recovery and rate of return. So is it worth the cost? That depends on the system. It depends on your personality. It depends on how you trade. This method protects your capital at the cost of growth and time. It costs your rate of return and it costs the time spent in drawdown. In other words, the time in drawdown will be a little bit worse using this method, but if you want to constrain your risk within certain parameters, sometimes these are the prices we have to pay. Conceptually, this is basically the opposite of the martingale strategy. The martingale strategy dictates doubling your position size, your risk for every bet you lose. That doesn't really work in trading. That's extremely dangerous. You kind of want to go the other way. You want to reduce your risk the worse your losses get, if you want to manage your risk properly. So that's a good way to think of this approach. It's the opposite of the martingale strategy. We're not doubling down each time. We're slowing down. We're reducing risk. We're managing risk more conservatively as the system gets more volatile to the downside. Let's look at drawdown mitigation number 7. This is an interesting one. This is another thing I learned from Nick Raj from one of his blog posts. I've never tried this, but it's something that I find very interesting, and it's worth exploring if you have the means to. How this method works for reducing drawdown is we plot the equity curve of a system we are trading on a graph using Excel or some sort of backtesting software. We calculate a simple moving average or a linear regression or some other way of measuring the average return of a system. And when our real trading equity drops below the average of our equity curve, we stop trading the system in real time. However, we continue simulating the equity graph on real-time price data. So I'll try and put together a visual example that I'll put on the screen here to show you guys what this would look like visually, because I know it's a little bit tricky to think about in words, but this system is basically investing itself when the system is doing well and going to cash when the system is really struggling. And we determine if it's doing well or struggling based on a moving average of the equity curve itself. So this is quite an advanced risk mitigation technique. And so we restart live trading when our simulated equity recovers above the moving average. So yeah, the risks with this are the same as number 6. It slows our drawdowns, but it doesn't stop them entirely. And it doesn't work great on trend following and momentum systems that depend on big wins. Some systems depend on you being invested in the markets during bad times in order to make money. And so you need to be careful with this approach like this. It doesn't suit all trading systems. It's probably better for shorter term systems that do a lot of churning, a lot of active trading. Like my Russell 1000 mean reversion system might be a good example of a system to employ this sort of approach on. Something that takes a lot of trades frequently and has an equity curve that doesn't depend on catching big wins in order to be profitable. The other risk is it may be chasing winners constantly. You may see a lot of whipsaw. If you're going to cash when the system's not doing well and then investing when it's doing well, typically markets tend to sway between doing well and not doing well, not doing well. And if you're constantly going to cash when the system's struggling, then investing when it's doing well, you might be playing catch up constantly, chasing winners in the markets constantly. And that can be an issue with some systems. So be careful of that. All right, the final tip, and then we can wrap up this video. I know it's a big information dump. I don't want it to be too long. We'll try and wrap this up here. This is an interesting one. I learned this from Cesar Alvarez during an interview. I believe it was with Reina Tio. I know a lot of people aren't fans of Reina Tio. I learned an interesting story recently about a plagiarism case with Reina Tio, which was disappointing to hear about from a very reputable trader. I won't say names, but that was disappointing to hear. But Reina Tio does some great interviews. He's got some great interviews with traders out there. One of those traders is Cesar Alvarez. And Cesar has an approach for portfolio ranking his systems. So Cesar trades several different systems, but not all at once. Some of them are sidelined and in cash or inactive, while others are active. The way he does this is he developed a way to rank his relative system performance. So like a relative momentum system that ranks stocks against other stocks to determine what to buy or sell. He does that with his systems. So he has a way of ranking each system in his portfolio. He has a way of ranking its performance relative to other systems in his portfolio over a certain period of time. Let's say it's a year. And he only trades select systems in his portfolio which meet certain criteria and the others are sidelined. This is similar to tip number 7 and carries similar risks, which we'll get to in a moment. But let's give an example here. Let's say you have 8 trading systems that you like and are comfortable trading, but you only want to trade 4. You only have the capital for 4. Splitting your capital across 8 systems might be a bit tricky, or especially if you've got more than 8. So let's say you only want to trade 4 of these systems in the live markets. One way to do this is you rank each system's past performance over the past year historically. So it's historical backtesting performance. You find some way to rank these systems objectively. So that could be a MAR ratio, ranking based on max drawdown over that time period, or more importantly, the correlation to each other. Maybe you just don't want the systems to be correlated, so you want to diversify, maximize your diversification. You find a way to rank your systems, and then you cycle into the top 4 ranked systems each 12 months. So every 12 months, you analyze your systems, see how they performed, see if the sidelined ones have been doing better than the ones you've been live trading, and maybe you rotate into those systems. That's one way to avoid drawdowns. It's also one way to avoid trading a broken system, because if a system stops making money, it will, by definition, if you've got a good ranking method, will sink lower and lower in the rankings, and it won't be traded. And eventually, maybe a couple of years in, you'll realize, hey, I haven't traded this system for quite a while. It's probably broken. You can remove it from your portfolio and cycle in a different system. That's a good way to avoid trading a broken system. However, it does come with some risks. The first notable risk is past performance bias. Usually a system does well, then doesn't do well, like I mentioned earlier. So by constantly cycling into the system that's been doing the best, you run the risk of constantly chasing winners, like we said about tip number 7. You also have the overfitting risk, chasing past winners without accounting for market behavior changes. So just because a system did well in the past 12 months doesn't mean it'll do well in the next 12 months. So there's some risks here. It's probably not a big deal if you've got a decent, robust portfolio of systems and you're rotating several in. But if you're only rotating 1 or 2 in, this could be a big problem. Correlation is also another big issue. If you are trading multiple systems and they're highly correlated, by definition, their performance metrics are going to be similar. And so let's say you have 2 or 3 different mean reversion systems and the past 12 months have been great for mean reversion systems. Of course, your 3 mean reversion systems are going to cycle in, and now you're increasing your risk. You're not reducing it because when the drawdown inevitably comes for that mean reversion technique, all 3 of those systems might go into drawdown and you might have overlapping drawdowns, and that's going to be nasty. So that's something to consider as well with this particular approach. And that sums up my 8 tips. I hope you found them interesting. I know they're not perfect. They're not a one-size-fits-all sort of approach. They're not a magic bullet that kills drawdowns entirely, but these are practical, robust techniques that you can explore in your trading to mitigate drawdown without getting crazy, without doing things that are highly risky, aside from the mentioned risks, which can be managed if you're smart about it. I just want to jump in here with a couple of honorable mentions / bonus tips. I picked up a few of these from the Realtest backtesting software forum. That's the software I use to backtest my stock market systems. I use TradingView for Forex, but for stocks, I use Realtest. I've got videos on the channel on how to get set up with that software if you're interested. But here are a few honorable mentions. The first one is regime filters. Regime filters or index filters don't suit all strategies, but they can radically improve certain systems, especially trend following and longer term systems. If you don't know what a regime or index filter is, there will be a video link in the description explaining it. Basically, you add a moving average to a market index that represents the universe you're trading. So if you're trading the S&P 500, you might use SPY. And if that market is trading below a key moving average, such as the 200 SMA, for example, you stop taking new long trades until the broader market recovers. A filter like this can be very effective for certain systems and can have a huge positive impact on reducing drawdown for that system, with minimal cost to your rate of return for that system. The second honorable mention is scaling in and out of positions. Rather than entering your positions at full size immediately, scaling in slowly can help reduce drawdown, especially for mean reversion systems, which tend to buy a huge chunk of a market in the middle of it crashing. It's happened to me many times. It's just the cost of doing business with mean reversion systems sometimes. There's a fine line between buying the dip and being hit by a freight train, and scaling in can help with that issue for certain systems. The final honorable mention is volatility filters or volume filters. They're almost the same thing, but not quite. Spikes in volume don't necessarily mean a spike in volatility, but it can mean that. But large volume or volatility spikes may be a red flag for certain systems. If market volume spikes or volatility spikes on the individual asset you're trading, such as a stock or a currency, or a broad market gauge, such as the VIX index going haywire, you might want to sideline your systems temporarily depending on the system. And finally, let me know what methods you guys have heard of down in the comments section, or send an email to support@theartoftrading. Let me know what you have experienced, what you've heard of, what you've learned. or thought up to mitigate drawdowns. And finally, I said at the start of the video we would cover the question, is my system broken? But this video is way longer than I expected already, so I'm going to wrap this up here and we'll cover that question in a future video. It's a subject worthy of its own deep dive. The core way to know if your system is broken, truly broken, and not just going through a natural drawdown is, I'll just briefly go over a couple of the slides I put together without elaborating to save time. But the core question is, did it fail to capitalize on its ideal market conditions? So if you have a trend following systems and the market's trended strongly for the past 6 months or so and your system failed to make money, that's a bad sign, that's a red flag. Seems obvious, especially to experienced traders, but to newer traders, they don't tend to think like this. They just think because it's losing money, it must be broken, but that's not true. Sometimes systems will lose money and should be expected to lose money during certain market conditions. A sideways market is not going to produce good results for a trend following system. That's normal, natural, and if your system goes into drawdown within reason, and it's a tolerable drawdown, and it's not catastrophically bad, then it's fine. That's normal. That is why I strongly suggest traders look into and do research on trading a portfolio of multiple systems designed to capitalize on multiple market conditions so that you can survive periods of time like that without having to turn off systems, use discretion, unreasonable amounts of discretion. Here are a few other points that I'll elaborate on in a future video. And finally, here are some ways to avoid trading a broken system and system hopping. So you can pause the video and read these if you're interested. Again, we'll cover this in a future video in much deeper detail. So in summary, check out the other videos on my YouTube channel. You might find them interesting. Check out theartoftrading.com for podcasts, some of my coding courses for system development in Pine Script. I have other courses I'm working on, backtesting course that I want to put together, and some other bits and pieces that I think you guys will find interesting if you are a developing trader. Check out the resources in the video description. Take care and invest time in developing your trading systems properly, and you'll avoid a lot of these issues down the line. Manage your risk, or risk will manage you. That is for sure. I don't know what that means exactly, but I don't want to find out. Just manage your risk, all right? Otherwise, you're going to be in for some nasty surprises down the line. In a future video, we'll cover the question, is my system broken, in more detail. We'll go through some examples. It is a subject worthy of its own deep dive. With all that said, I hope you found this video interesting. Best of luck with the trading, and I'll speak with you in the next one. Make sure to subscribe if you haven't already. I love you guys. Take care. Goodbye.